When we just get into a chart, our goal is to increase the clarity so we know what are we looking to plan. We do that step by step, and it begins asking a few questions. The very first one should be, what is the trend? We can see that this market ends up to the upside, so it's not hard to say that this is an uptrend, but that's not enough. And we really must do a directional analysis of the swing levels. That means that we look at how the highs and the lows are being formed. And so far, if we closely look at it, we are going to see two crucial things. The fact that each high was higher than the last highs, so we had repeated higher highs, and each low was also higher than the last low. Having repeated higher lows, these two together are formations of a market that's in an uptrend. But if we look at the last price action, on this downside push to be more specific, and we continue the directional analysis, we see how this downside push broke below the last low, this forming the first lower low. Now when the market was following an uptrend, as we know the uptrend has higher low formations, but then the first lower low prints on the chart, that's the first major sign that this market could potentially shift into a downtrend. It's what it's named as a market structure shift. And what it does is that it reverses the swing points. If before we had higher highs and higher lows, after the lower low, we should have a lower high coming up next. And a lower high is basically a pullback to the upside that should not be able to break above the previous high. Instead, it needs to end below. We don't know where it will end, but we only need an approximation. And with approximation, a lower high should many times end on a supply or resistance. The supply or resistance is the last upside candle before the market started the pressure to the downside, which in this case, that's not hard to identify, should be around this candle. So the pullback should end somewhere inside this level, before eventually turning back down in hopes of continuing the downtrend that it just started, and a downtrend continuation is met when the market keeps forming lower highs and lower lows. So if we know there are higher probabilities of a lower high, we can plan a sell setup from this supply. Around the bottom, it's the most common entry. You can also place the entry higher on the supply. It increases the chances of missing the entry in a situation where the price hits the supply but doesn't get into your entry. So you were right about the direction but didn't gain anything from it, which is one of the most frustrating parts that you might want to avoid. But for now, let's get back into the other two targets, being the stop loss, which should be placed above the supply. This way, if the market actually creates a higher high and the market proves us wrong, we lose as little as possible. That's the logic behind this placement. And the take profit should be below one of the previous lows since we expect some form of a lower low, basically a downtrend continuation. But if we place it below the recent low, we don't even get a 1-to-1 ratio. It's even below 1-to-1. When this happens, you target the previous lows, the ones from below, in such a way to get around a 1-to-2 ratio, or slightly more, but not by a lot. Price hits into the supply, opens the sell setup, and it quickly drops down. So we only need this price action to keep going like it is right now, because eventually it will get closer and closer to the take profit target. And finally closing on the take profit. Now that was when the market's clarity is already pretty high, but what if the market is moving more random and out of place? It's still the same step-by-step process, we just need to pay more attention and have patience. Let's look at this one for example. So we start with the directional analysis. Then we look at the swing points the market has been forming. We started from a low into a high. This was a straight push to the upside. Then from this high, it pulled back down. And shortly after, it pushed to the upside once again, this last upside push, managing to break above the last high. So we have a validated higher high. And if the higher high validates, that means that this low was a higher low. As we mentioned on the previous market, a higher low that is then followed with a higher high is a price action pattern of an uptrend. They are swing points of an uptrend. On uptrends, you normally look to plan buy setups from demand or support levels, which are the last bearish candle before the market started to gain bullish action. But in this specific case, we can see the market breaking down this demand. So if the demand broke down, that means that it also broke below the last low. A break of the last low is of course a lower low. Now after a lower low, what should be coming up next is a lower high. But here instead, it continued to the upside, broke above the last high, and formed a higher high. This leaves a confusion because we have a lower low, which is a swing point of a downtrend, but we also have a higher high, which is a swing point of an uptrend. When this happens, it's best to just wait until the market gives more clarity in the direction it's going. The worst thing to do is to force a trade when you have 50-50 chances based on the direction. So if we just wait, we see that in this specific scenario the market went lower and formed another lower low, So recently, we have one lower low, a higher high, and another lower low. 2 bearish points and 1 bullish point. To make sure we increase the quality and probability, we just wait for one more confirmation, and we see that it pulled to the upside and then pushed down into breaking the last low. So if we have another lower low, then we pretty much validated that this is a lower high. And now, on the recent price action, we have a lot more bearish swing points that indicate a potential continuation of this downtrend. The continuation is done by holding this repetition of lower highs with lower lows, which after it did held for one more time from the price action that we're able to see, it pulled to the upside and then pushed down and broke below the last low. After the downside break, it validates a lower low. And if we have a lower low, we validate the last high as a lower high. So on the recent price action, this pattern holds pretty well. If we expect a similar pattern to hold at least one more time, that means that after a lower low, we should be seeing a lower high. The lower high should be seen as a pullback to the upside that is not able to break above the last high, and it must end below this high. We find with approximation the level the pullback should end with the help of a supply zone, which is the last bullish candle before the market had the downturn. After we identified the level, we just place alerts or have patience for the market to maybe pull back into the supply. Here, for example, since we're on the 4-hour chart, it took a while, but eventually it did hit on the supply. Now we have two options. We can sell short from there, on the simple way, and this would be a swing setup. Or we can use this supply in confluence with another supply from a lower time frame. Let's try that on this one. We switched on the 15 minutes time frame on the exact moment the market has hit the high time frame supply, the supply that was taken from the 4-hour chart. And here on the lower time frame, we start the analysis again step by step. But for this price action, we started from a low into a high. From the high, the market pulled back down and then pushed a lot higher. This upside push breaks above the last high, validating a higher high. That means that we also validate the past low as a higher low. So far, these are swing points of an uptrend. Then from this high, again, the same things happened. We got a downside pullback that later got faded to the upside by another push to the upside. This again breaks above the last high. When the higher high has validated, we are now sure this low was a higher low. Now, when the market enters into the high time frame supply, that's when we need to be careful because we can't keep a bullish bias on this low time frame, unless it keeps holding this bullish price action until it breaks the high time frame supply. It's only when the high time frame supply breaks to the upside when we can say that this market is following an uptrend. But until then, this whole bullish action on this 15 minutes time frame is just a pullback of the higher time frame downtrend that has quite high chances of pushing down from this high time frame supply. So let's see the continuation. So far, it kept a similar price action. A pullback to the downside that gets followed with a push to the upside that breaks above the last high, forming a higher high that couples with a higher low. But soon after that, the price pulls down, and if we look at it, it breaks below the last low, creating the first lower low we've seen in some time on this low time frame. When the market was in an uptrend, which it was on the 15 minutes time frame, the first lower low is a trend shift into a downtrend, and a downtrend has lower lows, which we already have one right here, that should be followed with a lower high, which should be the next swing formation. The lower high is a pullback to the upside that ends below the last high, meaning that it can't break above, and we use a supply zone to identify with approximation where the lower high should end up. The supply being the last bullish candle before the market started to push down, taken from the last high. And the market is sitting right on the supply at this exact moment on this candle, so we can plan a sell setup right away from the bottom of the supply. Stop loss above the low time frame supply, and the take profit below the last low. And if the risk-reward ratio is kind of low, we target a lower level, so one of the previous lows, until we get a decent ratio, which I believe it's around 1 to 2.5, at most 1 to 3, but rarely above, which this higher low from below can give more than enough. And the next candle after filling the supply, it pushed down aggressively, holding a continued bearish pressure, so having patience because this might take a while, but eventually respects the theory and holds bearish continuation. And all we did with this sell setup is to follow the trend. It's why heavily focus on proper price action analysis, especially on the program linked in the description. We simplify complex concepts. Also, I highly suggest you watch more of our content. You might find a lot of value from these videos.